All right, let's get right into it. When you hear China and economic power in the same sentence, what's the first thing you think of? For a lot of us, it's that giant mountain of cash, right? Their foreign currency reserves. It feels like this untouchable war chest, a symbol of pure financial strength. But what if? What if that whole story isn't quite right? What if that mountain isn't nearly as big as we've been told?
I mean, look at that number, $3.3 trillion. It's just a mind-boggling figure. It is, by far, the biggest pile of foreign reserves anywhere on the planet. And based on that number alone, you'd think, yeah, they've built an impenetrable financial fortress.
And, by all the usual ways we measure this stuff, that's absolutely true. You stack up those reserves against the size of their economy, or how much they trade, or even against what the IMF says is a safe level, China looks golden. The story seems pretty simple. They have more than enough cash to handle pretty much anything.
But here's the twist. This is where that simple story really starts to get complicated. Because what if being massive isn't the same as being massive enough? What if we've been looking at this whole thing completely backwards?
So let's just try something different. Instead of comparing China's reserves to things outside the country, like trade, what happens if we compare them to something massive inside the country? Let's talk about the total amount of money held by Chinese citizens and companies, what economists call the M2 money supply.
And the second you do that, whoa, the whole picture just flips upside down. Take a look at this chart. On the left, you've got countries like Kuwait and Saudi Arabia. Their reserves are a huge slice of their domestic money supply. Now, look for China. See that little red bar? All of a sudden, they're the outlier, and not in a good way.
Okay, so let's put some actual numbers on this, because the difference is just staggering. China's reserves, they cover just 7%, a tiny 7% of their own domestic money supply. Now compare that to, say, India. They're sitting on a buffer of over 80%, or Saudi Arabia at 60%. From this angle, China's position starts to look incredibly fragile.
Yeah, as one analyst put it so well, suddenly that $3.3 trillion mountain we started with, it's looking a lot more like a molehill.
So just to be clear, what is this M2 we're talking about? Well, you can basically think of it as all the money, cash, checking accounts, you name it, held by Chinese households and businesses. It's the entire pool of local money that, if people started getting nervous, could suddenly decide it wants to leave the country. And that is the key.
So, okay, if the risk isn't what we thought, then what is the real danger here? What does this tiny reserves to M2 ratio actually mean for China?
It means the number one threat isn't some hedge fund in New York trying to bet against their currency. No, the real risk is domestic. Those reserves aren't a shield against foreigners. They're a very thin wall trying to hold back their own people if and when they decide to move their money somewhere else.
And listen, this isn't just some hypothetical idea. We're talking about real people. Regular families getting worried about the economy and wanting to protect their savings. Wealthy people looking to move some of their assets out of the country. And yeah, even officials trying to quietly get their money offshore. Every single one of those decisions puts more and more pressure on the yuan.
This isn't the first time we've seen a story like this play out. There's actually a really powerful historical precedent that should serve as a major warning sign. And for that, we have to look at Japan.
Okay, so on the left, you're looking at the value of China's currency right now. It's a chart of the real effective exchange rate, or REER, which is really just a fancy way of saying how strong the currency is against its trading partners. And as you can see, the yuan is incredibly strong. Now look to the right. That's Japan's currency. After their huge economic bubble burst back in the 90s, the yen just went into a freefall. It dropped a whopping 60% from its peak. The two charts, they look eerily similar, don't they?
And that's the whole point. China is fighting against the exact same kind of economic gravity that brought the yen crashing down. They're facing a lot of the same problems Japan did, a shrinking trade surplus, an aging population, slowing growth. All of these things create this immense, natural pressure for the currency to get weaker.
And all of this puts Beijing in a massive bind. It's a huge policy dilemma, and there are just no easy answers. They are well and truly caught between a rock and a hard place.
So on one hand, you have the push. Their economy is struggling, growth is slowing down, they're facing some serious demographic challenges. The economy desperately needs a boost, and one of the classic ways to do that is with a weaker currency. It would make all their exports cheaper and really help get things moving again.
And you can see that economic pressure right here.
This chart? It's showing how much new money foreign companies are investing in China. See that sharp dive on the right? That is a huge red flag. It's a sign that confidence is weakening. Normally, in a situation like this, a country would just let its currency fall to make itself more attractive.
But then you have the pull. The government is doing the exact opposite. They are fighting tooth and nail to keep the currency strong. Why? Well, they're terrified that if the yuan starts to fall, it could cause that stampede for the exits we talked about, a stampede their small reserve buffer couldn't stop. But it's more than just fear. A strong yuan is also about power and prestige. It lets Beijing project strength and makes their big overseas projects cheaper. And they do not want to give that up.
And you can see that fight playing out every single day. The purple line here is where the market thinks the currency should be. But those gray bars? That's the government stepping in, pushing the value of the yuan up, keeping it artificially strong. They are literally fighting the market, day in and day out.
So that's the trap. It's so clear. Their economy really needs the medicine of a weaker currency, but they're too scared to take it. They can't risk the side effects because they know they don't have enough reserves to handle a potential mass exodus of capital from their own citizens.
Which leaves us with one final, really big question. In economics, just like in physics, gravity is a very real force. It always wins eventually. So the question isn't if the pressure will win, it's how long can Beijing possibly keep fighting it?